All right, my friends, so I can't tell you how many comments or emails I get stating that you should get out of the market or not buy in now because we're at all-time highs. It's nuts how many people say this. Or you should sell because we're at all-time highs. It's just odd to me. So anyway, the way I say is, well, what's the market going to be? Let's say we're right here. What's the market going to be in 5 years? The way to ascertain what you should do next is say, what is the market going to be in 5 years? Will it be higher, lower, or even? That's it. All right, so if it's going to be lower in 5 years, you should get out without question. If it's going to be even, you should go to CDs without question. If it's going to be higher, you should stay. It's literally that simple. What is the market going to be in 5 years' time? Higher, lower, or even? And if you think it's going to be higher, then you should be 100% full throttle in the market, given your expenses and whatnot. If you don't think that's the case because whatever, Trump or Elizabeth Warren, why even mess with it? I don't get it. Why even mess with it? You shouldn't let your politics determine your investment, but I get it. People do. So you're saying if you don't think it's going to be higher, then why? That's the thing about stock market investing is optimism. You assume it's going to be higher. So, well, I think it's going to be higher, Josh, but I think we're too high now, so we need to fall back a little bit, bear market. Then I'm going to jump in, and then I'll wait for it to get higher. See, that's just odd to me because you're already saying you think it's going to be higher 5 years or 10 years, whatever. So now what you're saying is instead of going from here to there, I'm still going to get here as long as I don't do anything. What you're saying is I'm going to take the risk to say I'm going to do it when it falls. And I know when the bell rings at the bottom, I'll jump back in at that point. All right, so let's read this article from UBS that talks about conquering your fear of highs. This is Dateline July 2019, and so they say it's expired. I mean, you can read up, put a link to the show notes, but they're saying views may have changed. They don't want people to sit there and say, oh, this is what you said in 1922. All right, so this is Dateline July 2019. After breaching 3,000 for the first time on Wednesday, the S&P 500 finally closed above its milestone on Friday. But while investors are likely pleased with their market returns so far this year, they may also now be worried about staying invested at a market all-time high. We all know how bad it could be. The peak drawdown is about 55% in the S&P 500 in from 2007 to 2009. But most of the time, investors have not been so unlucky. So what exactly is the risk of a drawdown after buying into the market? Based on a monthly total return data since 1945 on the S&P 500, the risk is not as high as you might think. Assuming an investor bought at a random point in time, so going back monthly, so 1945 to the end of 2018, you're just buying whenever you got money, you're putting it in there. So you put $100,000 in there in this day, all right, and 28% of the time you'd never have fallen below the initial $100,000 ever. 50% of the time, the most you'd have ever lost is 5%. All right, so $100,000 in here in 1945, 1963, 1960, it doesn't matter. 28% of the time, you never went below 100,000. 50% of the time, you only went 5% or less. Just 22% of the time would you have lost 20% or more, a bear market. So that's less than 1.25. Of course, today is not a random time. We're at an all-time high. So we have also zoomed on the 1/3 of the time where market was trading at its all-time high to include dividends and analyzed the subsequent returns from there. Perhaps, surprisingly, an investor's odds from all-time highs would have been better. That's crazy. And 34%, over a third of the cases after buying at an all-time high, at no point would you have ever lost money. That's crazy. So 34%, if it's at an all-time high, over 1/3 of the time you put your $100,000 in there, did you never lose money? Whereas before, just random 28% of the time never lost money. In almost 60%, 59 to be exact, of cases after buying at an all-time high, you would have had no future drop below 5% to include your dividends. That's crazy. So buying at an all-time high essentially says 34% of the time you never lost money, 59% you never fell below 5%, and only 15% of the time did ever fall 20%. $100,000 at the all-time high, only 15% of the time did ever fall to $80,000 or more. It sounds counterintuitive, but investors should remember that for every 2000, 2007, when buying in at an all-time high, subsequently turns out to have been a bad idea. There were many more in 1982, 92, 95, 2013, 2016, where investors were subsequently richly rewarded for buying in at an all-time high. Investors would even further reduce their risk of drawdowns by investing in a balanced portfolio. considering a 60-40 portfolio of U.S. stocks to U.S. government bonds since 1945, in 35% of the cases, you would have never gone in the red if you would have bought at an all-time high if you had a 60-40 portfolio. In 68% of the cases, you would never fall in more than 5%. In just 5% of the cases, would you ever fall more than 20%. It would never gone down 30. But but that doesn't make sense to me, because you're saying I'll trade 40% bonds for a 1% increase and never losing money. Nah, in the past, I wouldn't do that. So the point is, you want to buy at the highs, according to stats, according to research. If you buy at the highs, you're actually reducing your risk of having a subsequent loss over the next however long it is, which is, again, counterintuitive. But again, it just shows the momentum trade, trends and momentum. That means something, the trends and momentum. You buy at the high, it has more of a likely to continue going up. You buy at a low, it has more of a likely to keep going down. That's the trends and momentum thing about investing. So at the end of the day, what you got to do is, where do you see yourself in 5 years from an investment perspective? Will the markets be higher or lower? And if you think it's going to be lower or even, you should get out. Just get out. Why even mess with it? If you think it's going to be higher, you should buy in and stay tight. That's it. All right. We'll see you guys next time.